Thank you for reaching out and expressing interest in what we do here at Nth Degree CPAs. Over the next few minutes, I want to walk you through how we are architects, not archaeologists. And you might be going, hold on, wait a minute. I thought you guys were CPAs. I didn't think you were an architect or an archaeologist. So I'm going to explain more about what that all means and why that's very relevant to what you're likely trying to accomplish. But first, I want to talk about what's going to happen when we get you on a scheduled call. Perhaps most importantly, we want to learn about you and what caused you to reach out. Then we want to share a bit more with you about why we exist and our process. That sort of goes back to this whole architect versus archaeologist. And then ultimately determine if we're going to be a good fit to continue the discussion. With that, I want to go back to this whole idea of architect versus archaeologist. So there's a quote that I love that kind of anchors everything we do here at Nth Degree CPAs. It's widely attributed to W. Edwards Deming. It says, every system is perfectly designed to get the results it gets. That means three things if you don't like the results you're getting. Number one, you can choose the path of least resistance, choose essentially the certainty of misery, and just kind of accept it. It is what it is. It's unfortunate, it sucks, maybe you feel like a victim, so you can just sort of accept it. I don't recommend that because then you're choosing to just accept results you don't want. But assuming you don't want that, which is probably why you're on this call today, you're not happy with what you're paying in taxes, you're not happy with the growth of your business, not happy with the overall financial position of the business, or you have some pretty large goals where you know you need to behave differently in the future, you know that you want different results. And so we can either change the system or change how we're behaving within the system. So in some cases, changing the system is not possible within the timeline that we would accept. That would be like trying to change the tax code. Timeline is not likely to work. We're not going to we're not going to run for public office and then try to change the tax code. So that means we need to modify our behavior based off what the tax code allows. That's what the ultra high net worth and big corporations, sophisticated investors have known for decades that they need to do. Or you might need to change your behavior, which are some business practices, the way you're operating, functioning to get different financial results. And that's where this whole archaeologist versus architect conversation comes up. So the traditional CPA is more like an archaeologist. They're just focused on the past. So when they say this is this year's taxes, they're talking about last year. When they're talking about this month's financials, they're talking about last month. And that's really problematic because we just established that we need to be future focused. We need to change a system. We need to change our behavior because we want a different result. And that's inherently future focused. But the traditional CPA is very much focused on the past. And that's what creates a system that's getting you your current results. It's causing you to pay the highest average tax rates. Or marginal tax rates. It's causing you to not get the financial results or have the financial clarity that you want. With that, hi, my name is Dan Nicholson. I'm the founder and CEO here at Nth Degree CPAs, and I like to tell people I'm an accidental accountant. Yes, I have an accounting degree. Yes, I'm a CPA. So you might be wondering, how is he an accidental accountant? Well, I was that kid growing up, scheming on business ideas, very entrepreneurial. Didn't go into business school to get an accounting degree, but at the end of my freshman year, I ended up getting a job at UPS, the big shipping company, as a part-time finance supervisor, managing a team of about 20 folks, reporting up to the regional finance manager and ultimately up to the regional controller. Still a strange story and still confused why they gave me the job and all the responsibilities. I was almost completely autonomous most days, managing a team. My managers were in an entirely different office, 20, 30-minute drive away. And as I got that experience, they started pitching me on the idea of getting an accounting degree, and sort of around the same time, the business school and accounting department took me out to lunch, and they shared with me all this data, in particular how there were, at the time at least, more Fortune 500 CEOs that had accounting degrees than any other degree. And so given my kind of entrepreneurial goals, that was attractive to me, and also a snapshot in my personality. Accounting is typically the most masochistic, most difficult of the business degrees in terms of time involvement. So that sort of catered to my personality a bit. Largely still thinking I was going to get this experience coupled with an information systems degree to be an entrepreneur. And then I went as far away as you might go from entrepreneurship, which is that same university nominated me for a fellowship at the Governmental Accounting Standards Board, their sister organization to the Financial Accounting Standards Board, same office, collaborate together. Ended up getting that fellowship and helped work on a derivatives and hedge accounting standard. And so if you help write a national accounting standard, that sort of solidifies you in many respects as an accountant. And so then I sort of was confused for a while and started collecting different experiences. I worked for Deloitte, which is the largest CPA firm in the country. I mostly had Fortune 5 clients who had $100 billion or more in investable assets. And then I worked for a Warren Buffett-backed company getting ready to go public. And then I worked for this guy, Steve Loudon, who went on to become CFO of Roku and take them public. And people kept hiring me, and I was collecting all this different experience in tax, systems, internal accounting, strategic finance, tax, as I was sort of moving around. And ultimately realized 15 years ago now that there was an opportunity to do something different in the CPA space, which is be more of that architect, future-focused for small business owners and high net worth individuals who weren't getting this level of planning that they need, like what the ultra high net worth was getting in the Fortune 500 companies. So if we weren't the first, we were one of the first CPA firms in the country to really lead with tax planning, CFO level guidance. Certainly when you add in that we've always operated on a fixed fee, not hourly, I think we're the first, but again, maybe there's someone I don't know about. Since then, we've been nationally recognized as one of the top 10 best-run mid-sized firms in the U.S. I've been named top 40 under 40 global accountant 4 times. Unfortunately, I no longer qualify for that award. I'm no longer under 40, and I've written a Wall Street Journal USA Today bestseller called Rigging the Game, which you're going to get a free copy of as a thank you for joining and expressing interest in our services. So all that aside, is this for you? Is this worth continuing to watch this video? And depends. Are you a growth-focused business owner with at least $400,000 in annual taxable income? Are you tired of the traditional accounting solutions that archaeologists always focused on the past? And you know your business and money should ultimately help you live the life that you want. So it needs to be funding your broader goals. So if that aligns with you, then there's some essential questions. Do you want to turn your money into things that have a long-term benefit? I think the answer is yes, but oftentimes folks just want money now to pay for current expenses. And one of the core tenets of tax planning, for example, is being able to turn income or cash flow into assets. And that inherently is a long-term focus or longer-term focus. Are you willing to learn new things even if it means changing your mind? So there's things that you're going to have to do differently, behave differently in order to get the results. And do you want to learn how to take smart risks? In business, we've often been pathologized to think that we always have to go all in, bet on ourselves, bet the farm. But the evidence actually shows that that's not how we want to take risks. Rather, we want to take what's called asymmetric bets, where there's significantly more upside than downside. So we need to think differently about risk. With that, I want to share some statistics with you that really get into why we do what we do. Small business owners, frankly, pay the highest average tax rate. On average, it depends on the state that you're in, but small business owners are paying 40 to 60%. Meanwhile, sophisticated investors of big corporations paying 0 to 20%. You're probably already aware of that, and what most people think, though, is, well, I'm not a Fortune 500 company, I'm not a big investor, so that means I got to pay these rates. That's simply not true. In fact, to sort of provide some proof to this, the line in green reflects the top tax rates going back to 1980. So you can see back to 1980, top tax rate 70%. Now we're in the mid-30s. But the average rate, the rate in blue, is more like 15%, and it's fluctuated roughly 1 to 2 percentage points each direction. But even when we've had a top tax rate of 70%, the average rate is the same as what it is roughly right now. And that's because those who have a lot at stake are constantly modifying their behavior based off new incentives. And that's because the tax code is constantly changing. Yes, there are acts by Congress, the president, that modify the tax code, but that's not it. There's new products that are being developed constantly, but also there's new court cases that come out. And really, those court cases give us insights into what can be done. And so we don't need to take any unnecessary risks. We can copy what's already out there, what's already publicly available. And that's what those sophisticated investors, big corporations are doing. They're constantly future focused, modifying. Okay, there's new incentives. How do I take advantage of those? What do I need to do differently? So did you know, under the current code, that you can use deductions to reduce your taxable business profits by 100%. So you can reduce all business profits to zero. You can also use losses from real estate or business activities to reduce your taxable business profits 100%, plus another $500,000 if you're married or $250,000 if you're single, and any other types of income, so wages, interest income, dividends, etc. You can also use charitable contributions to reduce your taxable income by up to 50%, and there are some products and strategies out there that can make charitable make sense, meaning you're generating deductions beyond that give you some return. And you can also use tax credits to reduce your tax liability to zero. So these are really the categories. So you could, again, just to summarize, just within the business itself, reduce it to 100%. Or separately, you could use losses from real estate, losses from another business to offset those profits. And then stack on some other strategies. Now, you might be wondering how, and there's countless strategies. We could list off close to 150 different strategies that could be used to reduce your taxable income that would fit under these different buckets. And that's constantly growing and changing. And again, that's why we need to be future focused and staying up on the new legislation. Now, caveat here, this information is general information. This is not specific tax advice. These strategies may not be suitable for every individual or business, and the tax implications can vary based off your own unique financial situation. So it's recommended you consult with Nth Degree CPAs or your own tax professional before you implement any of the strategies outlined in this guide. And you need to make sure that you're in compliance with the current tax laws to optimize your financial outcomes. So as I talk about examples, just know that that's not specific individual advice for you. Now let's, with that, give an example. So case study, you have taxable income of $1 million, married, filing joint, not accounting for any state income tax. Your federal tax liability is $296,126,000. That's before we talk about self-employment tax. That's before we talk about federal, state income tax. $300,000, almost assuredly your biggest expense. Now you decide to implement some strategies to reduce your taxable income by just 50%, and you're going to repeat that for the next 5 years. So you're going to have $100 million each year in income for the next 5 years in this example, and you're going to implement strategies to just reduce it to $500,000. And you're going to reinvest that savings and get a 12% annual return. Your year one savings is more than half because of the way the marginal tax rates work. So year one savings, $180,376 per year. After 5 years, you've got 1.145 million in money in the bank, and after 10 years, you've got slightly more than $2 million in savings. Pretty significant, and that's just scratching the surface. We're not trying to even offset it by 100%. Now, again, ways you can do that are over close to 150 different strategies within real estate and business, charitable rules, credits that would allow you to legally and ethically unlock the savings. So oftentimes we're focused on, I got to make more. Every client you take on, every employee you take on, that's more risk. If you can make more with doing less, why wouldn't we want to do that? It's less effort and risk. So if we're talking about adding 18% to your income, going from 1.1 million to almost 1.2 million from the tax savings, why wouldn't we want to do that? Because it's less effort and less risk. Now, in the same example, we're going to, instead of, same amount of income, save 5 year period of time, save 12% annual return, but we're going to offset our income to zero using legal and ethical strategies. So we saved the full $296,000. After 5 years, we have 1.9 million in the bank that we've saved and recovered. And that 1.9 million after 10 years becomes $3.3 million. Again, this is just an example of working with less effort and less risk. Now, the reality, though, is that most business owners aren't properly positioned to scale or minimize their taxes. That's because the core tenet of tax planning is to turn assets and income and cash flow into assets. But if you're spending everything that you make and you don't have proper reserves, don't understand how to use leverage, then you don't have the cash to deploy to execute these strategies. And the consequence is you continue to pay the highest tax rate and you're unable to grow your business in the way that you want to. And so we have to build not just a plan for this year, but a plan that's multi-year to be able to, in some cases, year one, we can get to 0% tax rate. But depending on how you're positioned, it might be a multi-year plan. And why wouldn't it be? Because it's something we want to repeat year after year. It's not something we want to do once, as evidenced by how much money compounds by recovering these taxes that you've been paying. So we need to get properly positioned to scale and minimize our taxes. Now, unfortunately, 82% of small business owners go under because of cash flow issues. And there's a saying in the finance world, consistency over accuracy. So we need a consistent way of making decisions and executing. But the reality is from my experience and the several thousand conversations I've had with business owners, is that they don't have money rules other than have as much of it as possible. So they don't have a playbook of how they are investing, how they're making decisions. And so they might solve the same problem several different ways. They're not able to properly characterize the problem. Now, let me give you an example. During COVID, there was a bunch of free money, PPP funds, ERTC funds. There were also some loans, EIDL loans, or EIDL. And a lot of business owners took those funds, they up-leveled their lifestyle. So they bought bigger houses, hired more folks, moved their kids into private school, bought second homes, cars, etc. They treated that windfall money as if it were recurring, ongoing income. But it was a windfall, it was a one-time. And so now that some of those loans have come to bear, payback, they're in a tough financial position because of all the increased expenses. So we need to be able to label money that's coming in. Is it recurring, ongoing income, or is it a windfall? And then we need to have rules, parameters for how we handle that. And part of what we do for folks is give them a document to start. That's our 15 core money rules based off my book, Ringing the Game, fill in the blank spots that help you create this criteria that would sort of be the equivalent, back to my capital markets days, of having an investment thesis or investment playbook that you can execute and be consistent. Now, let's give an example case study. Say you have a business with annual revenue of $3 million. You implement money rules, and we have some other cash flow protocols that result in better consistency in decision making. If it just improves your decision making by 1%, 1% of revenue is 30 grand a year. Now, typically I see that consistency in execution is an improvement somewhere between 10% and 50%, meaning that by having the right frameworks in place, the impact is somewhere between, in this example of $3 million, $300,000 to $1.5 million. Now, this is qualitative. Unlike tax savings where we can show you direct dollar for dollar, this is based off experience, and some of you might go, this is BS. And that's fine if that's your reaction. But intuitively, I'd ask you to reflect on, if you were more consistent in your decision making, how much better would your business be performing? And I think there's a number there. Maybe it's not 50%. Even if it's 1% on a multi-million-dollar business, it's significant to the bottom line, and we're working with less effort and less risk. Additionally, some data, 85% of the net worth of a business owner is tied up in the value of their business. But only 2% of business owners actually know the value of their business. Most of that 2%, I believe, is because the business is being sold or being closed. In other words, the value in that case is zero. That's like putting a bunch of money into a 401k, retirement accounts, savings, and never being able to see the balance we need a scorecard. One of the hallmarks of extraordinary leaders, and I can speak to this from being mentored by some of the best in business, is that they want an external scorecard. They want to see the results. They want to know that the decisions they're making are accreting back to the growth of their business. And so for most business owners, we're driving blind. And I'll come back to ways that we help solve on that front. But, and here we are right here. So you have a starting valuation back to $3 million, and you implement our recommendations that show on average that when we implement these recommendations focused on improving the saleability of the business and enterprise value, that there's an average value growth of 29%. So year one, you go from 3 million to 3.8, almost 3.9 million. Now you might be going, how am I even going to know the value? Well, we have a tool called Interval that we've invested in. I think only one Big Four firm has this, and some large banks. It was invented by some people in private equity, but we invest in this tool so we can actually give our clients valuations usually within a couple business days. They're not as precise as paying 30 grand to have an independent valuation expert come in, but they're within one standard deviations. So it's close. And from that valuation, we have a starting point so we can measure where we're at and then implement specific recommendations that make the business more sellable. So you can have a really valuable business, but if you can't sell it because the business is solely reliant on you, it's going to significantly impact the valuation. And other growth specific strategies that we can uncover based off the initial valuation, what's limiting it, and based off some industry specific metrics that we can provide, show on average value growth of 29%, which means that $3 million business after year 5 is almost $11 million business. In some ways, this goes back to what's the value of consistent, timely information. Ultimately, something I tell clients all the time is you can't solve a strategic problem with tactics. And I'm sure you've got experience with this. Someone's selling you a marketing tactic, but the strategy is wrong. And really that's what I'm talking about, is helping solve strategic problems. And it starts with thinking a bit differently about cost versus investment. So a cost, in my words, is something that's required, something where you value competency over the ROI. You're not expecting an ROI. It's a cost. If your house gets flooded, it's required that you get it fixed. You got to file tax returns. It's required. Competency is expected, and reliability. In investment, it's optional. It's a bet. And we need to have a set ROI target. What's the return on investment we expect? And a timeline. And so this is an example of starting to think differently. So as an example, how oftentimes people think about whether or not it makes sense to work with us is they're paying a cost right now for CPA services. And I gave an example of $10,500, but you might be paying $500, right? But that's not the only cost, because one of the consequences of working with them is that they're an archaeologist. They're not giving you guidance around taxes. So the actual cost is the $10,500 in this example, plus what you're paying in taxes. So it's more like $315,000. But let's say that you made some to be determined investment, don't know the amount, in CPA services that are going to reduce your taxes from $275,000 to $100,000 in federal, and state taxes from $300 to $10,000. So your total cost is $110,000. In addition, you had some wealth growth. Business improved, you acquired some assets. So in this example, your wealth in this period of time grew by $200,000. So net, you're actually ahead $90,000 between the cost and the growth compared to $315,000. So what are you willing to invest in CPA services in this case? Presumably more than what you've been paying for the person who's just a cost center. And so ultimately pointing this out to think differently about when am I making an investment versus when am I making a cost. Part of what we do for clients is cost. You got to have your books. You've got to file tax returns. There's a cost to that, and you want it to be highly competent and highly reliable because it's required. And then you're making an investment that needs to have a certain rate of return that's going to save you in tax and it's going to grow your wealth. And net, you should end up ahead. In this example, it's a more than $400,000 swing between the cost to the growth. And so if I'm investing, again, it's optional. What is your ROI target? Typically, if I can get 2 times my money back in 1 year, 100% return, I'm taking it. 4 times, now it's asymmetric. 10 times, I'm doing this all day. So thinking differently. And that's not what you're getting from the traditional CPA who's an archaeologist. You need the CPA who is future focused. And for us, the real game, and I've alluded to this already, is that we want to help you live the life that you want. Fund what we call your solvable problem. That's our own intellectual property, how we take your goals and turn them into an equation so we can measure, are we getting closer to the outcomes that you want? And we want to do that in the least amount of time. That's not particularly novel. But I have said throughout this presentation, effort. We want to do this with less effort, and we want to do this with less risk so that we have less obligation. And so many business owners are redlining on effort and risk, and they're missing opportunities because they don't have the time, they don't have the resources to execute on it. So we need to think differently. And that's how we help. So we help by crystallizing your money rules so you can be consistent. And then we pull these different levers. Improve your cash flow, so reduce taxes and costs. Increase your liquidity so that so we're being positioned to be able to execute strategies. That might simply be by improving our cash flow, we pay down some debts. So now we have more capital that we can execute. It may mean taking on some growth capital, and we have some tools to be able to calculate based off your business and cash flows, how much capital can you take on? That's thinking differently. That's growth capital. Oftentimes people are thinking about emergency capital. I'm in a financial duress. I need to borrow. Much harder to do in that situation. We want to do that because the game is to acquire assets that increase your cash flow. And then we want to take effort off the table and continue to repeat the process. So that's how we help our clients. It looks something like this in our proven process. We have a discovery session. That would be our first call, get to know you, identify opportunities. Then we're presenting to you some findings, potential ROI, working together. If you want to sign up, we have a kickoff session, move into what we call an acceleration session where we're trying to get some results right away. And ultimately, we're presenting a roadmap to you. Here's our series of recommendations with some of our proprietary methodologies. This is our plan for the foreseeable future. That leads to signing off on implementing it. So that's sort of a one-time initial process to build out a robust plan for you where we're uncovering these hidden pockets of opportunity for you. And then on an ongoing basis, we do all the things that a typical CPA would do in terms of tactical filing, but we're providing ongoing strategic reporting, KPIs, forecasts, biannual evaluations, saleability scores. We're having regular strategy sessions for you, sometimes up to weekly, quarterly refreshing your tax plan, doing ongoing cash flow engineering, access to some trainings we've developed. But part of also how we are unique in solving a problem that many CPAs face, which is they don't respond to their clients timely, is we have a dedicated account manager. We have designed a system where we're giving up to weekly status updates with an implementation tracker. You should know where things are at all times. This is our proven process. We've been at this for 15 years. Like I said, if we weren't the first, we're one of the first in this space with small business owners. And we take a team approach. So it's not just me, it's a team. We have technical directors, account managers, technical staff. We hire from top 100 accounting firms, 42,000 firms in the US. We're hiring from the top 100 firms. These people have often graduated top of their class, have passed the tests, have worked on notable clients. And what they want to do is help small business owners win. They want to do meaningful work with their clients to help them live the life that they want. So team approach, but you always have a dedicated account manager. So you're not being passed around. It's our job to bring on the right experts as needed to serve you, but you're not being passed around. How we ultimately serve clients is through 3 tiers. Tax optimization, that's building the initial plan. proactive tax planning, preparation of all your returns, dedicated support, proprietary systems. This is specifically aimed at helping you recover all the tax, clear ROI there. Then we have control over package, weekly bookkeeping, developing and monitoring of budgets, forecasts, industry-specific KPIs, insights like growth capital that is available to you, and some valuation support. Then our last bucket is sort of advanced CFO level. That's where you're getting more modeling and really access to my expertise and network of contacts. And so that's really suited for someone who's looking to do a lot of deal structure or deal flow, acquire other businesses, and really scale things out. So that's how we serve clients, but we're going to customize things to your specific need. So next steps are to join our call. And if we're a good fit, we're going to ask to gather some financial documents, have you complete an intake form, so we can identify opportunities, put together options for you that are customized to you specifically. Everything we do is customized. And we'll come back and present to you our findings, answer technical questions, discuss ROI, present a custom proposal. And if it's a win for you, if it meets your ROI requirements, and it feels like a home run and we're a good fit, then we'd be honored to proceed forward, having earned your business. But we don't just earn the business there, it's in serving you on an ongoing basis, being available throughout the year as an architect, serving you, helping you live the life that you want. So I appreciate you watching this video all the way till the end. Take care, and hopefully we'll talk soon.